What if the central bank just slashed Nigeria's lending rate, and ordinary businesses, farmers, and consumers suddenly had hope for cheaper loans? That's what's happening now, and it could reshape access to credit across the country. Central Bank of Nigeria cuts interest rates. OPS demands credit relief in a long-awaited move. The Central Bank of Nigeria, CBN, has reduced its benchmark interest rate, marking the first such cut in several years. The action spotlights a shift in monetary policy aimed at stimulating growth, easing borrowing costs, and revitalizing key sectors. Meanwhile, the Organized Private Sector, OPS, is demanding deeper credit relief, pushing the government and financial institutions to go further. What changed? The rate cut. The Central Bank of Nigeria lowered its policy rate to 27%. This is the first reduction since 2020. The decision signals a pivot toward more accommodative monetary policy as inflation shows signs of easing. Alongside the cut, there are expectations that commercial banks and lending institutions will pass on the lower rates to borrowers, especially in sectors that drive growth, such as agriculture, manufacturing, and MSMEs, micro, small, and medium enterprises. Why the cut was needed? 1. Economic stagnation and high costs. Many businesses have struggled under high borrowing costs, with interest rates often in double digits that choke investment and expansion. 2. Inflation easing. As inflationary pressures begin to moderate, the central bank has space to loosen policy without immediately risking runaway price growth. 3. Stimulating growth. By lowering the cost of credit, the CBN hopes to encourage borrowing, investment, and consumption, all of which could revive sluggish sectors. The CBN lowered its policy rate to 27%. This is the first reduction since 2020. The decision signals a pivot toward more accommodative monetary policy as inflation shows signs of easing. OPS's demands. Don't stop at the cut. The Organized Private Sector, OPS, which represents key business interests, is applauding the rate cut, but pushing for more. Their demands include deeper credit relief, not just lower rates, but moratoria on interest for struggling borrowers, restructuring of existing loans, and longer repayment windows. Faster transmission. Banks must quickly pass the rate cuts through to their clients rather than maintaining high spreads. Sector-targeted support. Special incentives or credit windows for sectors, especially hurt by inflation, power inefficiency, or supply chain disruption. Transparency and monitoring, ensuring that relief reaches the deserving, small and medium enterprises, farmers, etc., and not just big players. In a long-awaited move, the Central Bank of Nigeria, CBN, has reduced its benchmark interest rate, marking the first such cut in several years. The action spotlights a shift in monetary policy aimed at stimulating growth, easing borrowing costs, and revitalizing key sectors. Meanwhile, the Organized Private Sector, OPS, is demanding deeper credit relief, pushing the government and financial institutions to go further. Risks and challenges ahead. Transmission lag and spread persistence. Banks may resist reducing their lending margins, so borrowers might not feel the full benefit of the policy shift. Inflation reversal. If inflation picks up again, the CBN may be forced to reverse course, which would destabilize expectations. Credit quality and non-performing loans, NPLs. Existing bad loans may deter banks from aggressive new lending. They'll need assurances about risk mitigation. Liquidity constraints. Even with lower rates, if banks lack liquidity, they may be unable to expand credit. Fiscal/government borrowing pressure. If government borrowing remains high, it can crowd out private sector access to credit, weakening the impact of the rate cut. What this means for everyday Nigerians and businesses. Borrowing for personal and business needs may become more affordable if banks pass on the rate cut. Entrepreneurs, small businesses, and farmers may find it a little easier to access capital for expansion or operations. Consumer loans, housing, auto, etc., may see marginal relief if lending institutions cooperate. Those already under heavy debt burdens may benefit if relief or restructuring measures are adopted. What to watch going forward? how quickly and how much banks lower their lending rates to customers, whether OPS demands are taken up by government and regulators, changes in credit growth in sectors like agriculture, manufacturing, and MSMEs, inflation trends over the next few months, whether the cut is sustainable, performance of non-performing loans, whether banks open new credit or tighten.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.